I'm going to start recording now. All right, started.
Okay, cool. So let's start. Okay.
Great.
So, okay.
Hmm.
For team 2, I have put the primer in like the gist of the document, gist of my wordings or about the options in options primer page. And I have also made a few slides. So we'll walk through the slide and at the end we might go to the option primer because I don't have all the slides updated there. Uh, so I'm going to start from the beginning of understanding, like most of you are not from the background of the business or finance. So I'll take like just few minutes uh, in the beginning to give you a background of business and how actually the trading has evolved over a period of time. Yeah, if that makes sense to all.
Yeah, go ahead. Also, guys who are not speaking, just mute and then use the space bar to unmute yourself. Okay, if you're on laptop, and if you're on phone, I think you have to slide your left to speak. Right?
Full screen view. Okay. Okay. So to start with what can be traded in stock market, it is important to understand the types of business and how the business have evolved. So in India, there are basically four categories of business that you can set up. First, being a proprietorship business is being an individual owner. You don't have to register with any of the companies act. You just open, get your GST license, and you can run the business. Uh, so here you act as your own boss. There's no one to tell you like what to do, how to do, why to do. And one of the biggest drawback in this type of business is if you make a loss in the business, you're personally liable to pay those losses. Your personal assets would also be like liable, will be considered while if there's a loss in the business and if you have to pay your business liabilities. Going away from proprietorship, what we have is a partnership business. Here, you need to have at least two people to register as a partnership firm, and on a maximum, you can have a 20 partners. So mostly the decisions are based on the person who's holding the highest controlling stake in the partner. Like a person who has put, normally a person who puts more capital will get a more stake. So if you have to say divide the percentage between the owners, is like say if there's a capital of 1 lakh, then if person A is put 50,000 and remaining like three people put like equally, then the person A has more control on the business compared to the remaining three, and all the decisions are based on the mostly by the person who holds the capital. Here also the liability of the partners is unlimited. So if the partnership makes losses, the personal assets of the partners will be used to pay off those liabilities of the business. But if you register the partnership as a limited liability firm, then the liability of the individuals are restricted. So individuals are not liable to pay off the business liability. Uh, Going from this, there's another type of business called private limited companies. Now, the owners of the private limited company, we call them, 1 second. I think he's not around in this stuff.
Dipanshu, can you mute yourself?
Can I start? Yeah. So the
Vagram, just one thing.
yeah.
So now there is one more thing called OPCs, one-person companies. Okay.
Yes, exactly.
Uh, which is essentially to help freelancers limit their liability, right? So it's kind of like proprietorship with single owner, but then limited liable.
Exactly. Yeah, that is there.
Yeah. Okay.
Yes. Yeah, missed that one. So thanks for pointing out. So in the private limited company, you can have up to 200 members whom we call as a shareholders. Now the capital of a private company gets divided in a unit called shares. Now, say each company, when it is formed, they issue a number of shares, say like 10,000 shares of rupees 10 each to the shareholders. And the people who subscribe to them and the number they subscribe, they get the ownership stake in that business. The good part of the limited companies, either private limited or public limited, the personal liabilities are again restricted. So they are not personally liable for any of the losses that the business made. Now, the problem with the private limited company is it's hard for them to make an exit for any of the shareholders. So they have to either find their own investor who can come and take up their holding, and the other members can, not allow that person to transfer his shares. So there's many problems around this. So going away with this, there's a concept called public limited companies. Uh, Now here you can have a minimum of 2 members and a maximum, there's a no limit. Uh, Now, public limited company would either be listed with stock exchange or will not be listed in the stock exchange. So the companies which are not listed with the stock exchange would have a difficulty in terms of transferring the shares to other, because they can't find the other person. So the person who is transferring the shares have to find on his own the buyer of those shares. So to facilitate this transfer of shares, what has come up is the listing, the stock exchange in the stock market. So mostly the public limited companies get listed to themselves in this stock exchange to facilitate buying and selling of the ownership of those companies. In India, we got two stock exchanges. One is NSE and BSE. So they are sort of like a marketplace for the facilitations of share transfers. Now, as an individual, you cannot buy the share of any company. Say if you want to buy the share of Infosys, you cannot go to NSE and buy it. You have to go through a broker. A broker is then a member of a stock exchange, either NSE or BSE. You have to place your order, give a money to your broker account, place the order in your broker account, and your broker will send the order to the exchange and it will match the price. So so if you want to buy, say, Infosys shares at 100 rupees, uh, you will put your price there, and there has to be a seller on the exchange who is selling at 100 rupees. Unless somebody is selling at 100, you won't be able to buy the shares. Your order wouldn't get executed. So one of, in terms of management, it is again the ownership, the people who are holding more shares in the market would have the control on the company, like management of the company. So mostly the listed companies, they are either managed by the professionals or the person who is holding the more share. Mostly either they could be the traditional promoters who are holding majority of shares, and either they can be a managers or they can give the management to someone else. But all the decisions are taken based on the person who's holding a majority of the holding shares. So it could be either a combined group can take one decision if the combined exceed the majority, or it can be a single person who exceed the majority. Like a person holding 20% can take a major decision if nobody opposes him, sort of it.
Do you want to talk about the voting rights, like preferential votes and stuff?
Uh, I think getting there,
Not required.
uh, it's not required at this point, because the whole idea is for us to move on to the option side and how it works. So,
Yeah. MSP Pawan wants to join, but is unable to join. Posted on group.
okay. So do you want to see like how actually a trading would happen? Say, this is my broker account with Zerodha, and if I have to buy any share of a Reliance, I just have to place an order here. Like I say buy, and my last price, I would. So my order would be in the queue here. There will be buyers here. There will be a sellers here. Since the market is not open, these are all showing 0, 0. But this was my last price. So if I have to say like place 10 quantity order, the market, if I select a market order, it will just execute at the price who's selling to me, the lower person at the lowest price. So it's like you have the sellers here and you have the buyers here. When I'm placing a market order, it will select from the first seller whose price is lowest in the queue and execute the order. If I put my limit order, it will put it in the queue based on your price. So the highest price is the person who put highest bid is on the top, and the person who's put like lowest will get down the order. So I can just place a buy order and it will be sent to the market and order will get executed if it meets the condition. Now, so getting into trading, you can just trade only of the public limited companies which are listed in stock exchange. Buying is done through your broker account, and there are multiple brokers like Zerodha, SDFC, ICICI Securities, Angel Broking, lot of them. You need to open an account there. Um, now, uh, if you have to make an investment or become a owner of any company, you need to buy the equity shares which are traded in the market, hold them, and you then get a voting right based on the votings attached to those equity shares. Now, apart from being an investor, you can also do a trading, whereas you want to just gain out of sort of some price differences. So if you want to buy at say Reliance 1000 and you expect that the Reliance will go tomorrow by 1050, so that you can sell at you can gain a 50 points, you can place order today and sell it tomorrow. That you can do it. That's called positional trading, where you hold your position for a day or more, and uh, the one jargon what we say here is long. You're long when you're buying first and selling later. uh, you're short when you're selling first and buying later. So you can do a short only on the intraday transaction and not on a positional trade, which is not short selling in India is not allowed in the stock exchange in the equity segment. I'm talking of only when you're buying and selling the shares, equity instruments. In intraday, you can do a short, you can sell first, but you need to compulsorily close your position before the market closes. If you don't do, your broker will come in and he will close your position. So intraday, you can go both long or short. Now, coming to the derivative side, derivatives are the designed instruments, are contracts derived from the value of an asset. So, so here you will have there are four derivatives contracts typically in the market, not necessarily in the stock market. The futures, forwards, swaps, and options. Um, Futures and for options are traded in the stock market, but forwards and swaps they are generally not traded in stock market, but they are OTC contracts mostly dealt by the banks. Say what they in swaps, what they do is like they swap the interest rate of one instrument with another instrument. depending on their liabilities and all. So they are different hedging requirement, and they are generally not traded in stock exchange. Similarly, the forward contracts. Now we will deal in the stock exchange. We will deal with only two of them, the futures and options. So future is an obligation of the buyer to purchase an asset, and the obligation of the seller to sell an asset at a predetermined date and at a predetermined price. How does it work is in trading, NSC creates the future contracts 3 months in advance. So the terms of the contracts have been decided by the NSC, but the pricing and the trading has been done by the individuals. So if I go to my broker account and if I select, say, Reliance April future contract, what would this mean is so it will be traded as any other instrument, but it would have an expiry date of 30th April, which is decided by the stock exchange. And it will be traded in a lot. So if you have to buy any of the derivative contracts, you can't buy in a one single units. The units are being so this the number of shares of a company will be made in terms of a lot. So Reliance has like 500 lot. So if you have to buy one lot of future contract, it would have 500 shares of the stock whose underlying is Reliance. So if you want to just do a like futures contract or buying one quantity of shares, that is not possible for any of the derivatives instruments. So all the contracts are created 3 months in advance and they expire at the last Thursday of the month. In India, we have only around 140 companies whose derivative contracts are being traded in stock market. And when you're trading a futures contract, you can either obliged to buy an asset in the future date or obliged to sell an asset in the future date. So you can do both long. That means you're buying a contract now and you will sell it later. Or you can go short. That means you are going to sell a contract now and buy it later. On the later point, either you can buy it before the expiry from the market, or what you can do is hold it till expiry. But when you're holding in the until expiry, you would have to deliver those shares to the buyer of the contract, or your whatever price difference is there, that will be settled from your broker account. So the broker will deduct the price at which you have traded and the price on the expiry. That difference will be transferred to the either gainer of the contract. So if the price has gone up, it will be transferred to the buyer of the contract, and if the price has gone down, it will be transferred to the seller of the contract. So when you are understanding any of the derivative instrument, it is important to understand the open interest. So open interest is the number of contracts outstanding at any given point of time. It is different from quantity that is being traded. So let's understand from this diagram. Say on the first day of Monday, say when the contract has been created, Ajay buys 6 contract. He buys it and Varun buys 4, and both of them buys from Neha. So the volume for the day is like 10 contracts. So, and the outstanding contracts on that day is 10. Next day, Neha buys back out of 10, she buys back 8 contracts, and she buys it from John, who is selling at 7 contracts. and she buys it from John, who's selling 8 contracts. Now Neha closed her position, and her position went to John, and John's outstanding is 8. The volume for that date is 8, but still the outstanding contract is 10. So if you see, like, it's just not a volume addition. So here it was volume was 10, and Monday's volume is 10 and Tuesday's volume is 8. The total volume would be 18. But actually the outstanding contract is just 10. There's no changes. There's no new contract has been created. So what Neha bought is from her previous sell contract, previous day's contracts which she sold. But she sold it, Neha bought it from another contract writer called Johan. So now the holdings of Johan is 8, Neha has only 2, and Varun has 4 and 6. So again, the same way, so in a net, open interest is important to understand the liquidity of any contract. So before you place any order in the market, you should understand whether the contract is liquid or not. And you should take a position only where there is a liquidity, where the open interest outstanding is higher in number compared to should not this becomes important only say on the expiry of the day or few days before the expiry. The people try to close their positions, which would actually increase the volume in that contract, but the open interest would reduce. So that's when it comes in place, like whether you should take that position in that particular derivative contract or not. So let me go through few of the derivatives that are there in the market. So if you see, Indian Stock Exchange has like about 20,000 derivatives contracts being traded, but then problem with all of them is like they are not active, and it will be like say 140 stocks which are derivative contracts, and each stock will have a 3 months futures contract, which is like 140 into 3, about 350 or 400 futures contract will be active at a given point. And when you're trading, you would have to understand which month contract you have to take. So it is if you go more far of the contract, say if you're taking current, if it's April now, and if you're taking June contract, there will be a very less liquidity in those contracts. And a current month contract would have a more liquidity in the more liquidity, which is like you can easily buy without losing much in the slippage. Okay, so like if you see here, Reliance has so many stock contracts that are being traded in the market, just Reliance Group, and if you combine all, there will be like about more than like around 10 to 12,000 contracts that would be there in the market, and most of the contracts are from the options. So option would have different things. You will have a strike price, expiry date, and each stock would have about 30 to 40 or maybe up to 100 strike prices. So there will be like one stock would have 100 call options and 100 put options. So before going to the here, let's get into let's understand now what are options. So when you're an option is a right of the buyer. So a buyer can it gives a right to the buyer to either buy or sell a security, uh, and the seller is obliged to meet the rights of the buyers. So now in trading, option would have a few things. What is called strike price, the price at which the buyer can buy the right of selling the underlying stock, and the price at which the seller is obliged to meet the buyer's conditions. And it would have a expiry date by which those terms can be met. Either they can be exercised before, or they can be done after the or at the time of expiry. If the contracts are open, the exchange will do the settlement on their behalf. Now let's understand type of contracts, options, call options and put options. A call option gives the holder to buy an asset at a stated price within a time frame, and a put option gives the holder to sell an asset at a predetermined price and within a time frame. So if I say Reliance April 860 contract, in CE installment between uh, so Reliance April 840 CE would mean Reliance underlying is a Reliance, expiry is the end of April, which is given here 30th of April. 840 is my strike price, and CE is a call option. So that's a call option. And similarly, at the end, you will have a PE for a put option. So when you are buying a call option, the holder has the right to get the shares at a predetermined price. He has to pay a premium, and the seller has the obligation to meet the right of the holder. Similarly, for put option, the holder has the right to sell the option, and the seller of a put option has the right obligation to meet the obligation to give him the right, buyer of the option give him those shares or buy him for the shares. Some of the jargons used is strike price. As we said, the price, predetermined price at which the contract will be settled. Underlying price will be the price of an underlying asset. Now, exercising would mean exercising the right to buy or a right to sell the option. So when buyer of a want to exercise before the expiry, the seller will be obliged to uh, sell him those underlying asset on the whenever he demands for it. But how does it work is, in market it gets traded. So once a contract is created, you can sell it to someone else. You don't have to just give it to the same seller. So what will happen, it is like it will get settled on the premium. So the premium is the price at which the buyer will be buying it. Options prime, yeah. So premium is the money required to buy the right of the contract and to be paid by the buyer to the seller. So seller would get the premium and buyer would pay the premium. But on exercise, the seller would have to, if it is not a physical delivery, then the seller would pay the difference in the strike price and the spot price of underlying to the buyer. So we will understand those payoff later. Option settlement. Yeah, we spoke about lots. Lot is normally derivatives get traded in lots and not in a single quantity. So Reliance has like 500 lots. Nifty index would have like 75 lots, and so on and so forth. Now when you're trading in the market, specifically if either for a futures, you would have to put a money in your broker account. So you generally you will not be required to pay the entire amount upfront whenever you are creating a contract, but you will put say if you're buying Reliance futures, which is quoted at 1039. Now whenever you're buying this contract, you're not required by the, once again, so if you see this graph, this is for Reliance futures contract, April contract. Whenever you're buying, you say it is traded at 1039, and the one lot of Reliance is like 500. So you're not supposed to pay the entire amount upfront. That is like 1039 into 500, which is like about 5 lakhs rupees. Upfront to the seller. What would happen is like you will be given a margin by a broker generally, which is like 1/10 of the entire amount, or maybe 1/5. Premium of 171 around to the seller of the option. So what broker will do is like it will just do one lot, which is 500 into 171, which is about say 800 or 900 rupees. It will deduct from your account and give it to the seller of option. He will get credited for this amount. But if you're selling an option, what you will be done is your margin will be get locked, and you will it is uh, your margin will be get similarly what happens with a futures contract. So you would need to have about a 1 lakh of rupees margin to sell this options call option contract. So generally a seller of any option contract, or a buyer or a seller of a futures contract, would need to give a margin to your broker, which is like generally 1/5 or 1/8 of your total traded value. Hence, your investment here becomes the margin that needs to be put with the broker, and not actually the total value of the contract. Now, the buyers pay off in a call option. Yep, sure.
Hey, yeah. Do you want to take a moment, stop and check if people have any questions before you move forward? I think these are, you covered very important concepts if they have to understand all of this very well.
Yep, sure. Guys, let me know anything.
Was there a question?
Yep.
Hi, hello, can you hear me?
Yeah. Yes.
Buyers payoff in put option. I mean, minus gain is strike price minus 0 minus premium. Can you explain that, please? What the payoff is?
Okay, we'll go there in a bit. But as of
we haven't come there. Okay.
Is there anything that you have?
Sorry, I didn't know that you have not covered that. Come till there.
Okay. Okay, so then I'll proceed further. Say payoff for a call option. So as in a call option, you buy the right to buy a stock at a predetermined price called a strike price within a specified period of time. Now, in this case, a buyer pays the premium to the seller of the contract. So let's go and understand how it works actually. So if I see, let's. So what I've added here is a Reliance.
One question, Vaganam.
Sure, sure.
So generally, when we say, yeah, call option, we have the right but not the obligation to buy the underlying, right, at a certain price. I mean, but when in reality we actually play on the premiums only. I buy at a certain premium, and I sell at
Right.
a certain premium. That's my gain or loss.
Right. So
From a retailer standpoint, do we ever, from an investing or trading perspective, do we ever come across a situation where we actually exercise the call option or put option and then buy the underlying?
So currently, the rules in India have changed. So earlier, what used to happen is like if before the expiry, if you were not buying back your, if you were not squaring off your options contract, it, it were settled by cash. That means whatever the difference was there between the on the expiry spot minus your strike price, you will get that money. But now the SEBI has made it mandatory to physically deliver it, to do a physical settlement. What happens is like suppose if you buy a Reliance April 1000 C contract, which is a call option. Now by the end of even on the expiry, you don't close your position. You will be required to buy uh, those shares of like about 500. If you bought like one lot, you will be required by the uh, you will be required the seller will be required to give you those delivery of 1000 shares. So at the on the expiry, 1 or 2 days after the expiry, you will get like 500 shares in your broker account. So it is important you close your position before the expiry, and until expiry you can trade it. So either you will be able to buy it from someone and sell it to someone else. You doesn't know whom you're selling. So that's why like open interest become more important. Open interest is like number of contracts outstanding. So whenever you're deciding which contract I have to buy, it is important to see what is the liquidity of that contract.
So what
Who
we are
asked this
saying is,
question?
if I hold it,
Sorry.
Sai here,
Yeah.
Yeah, Sai Kiran. So I can give you one example in addition to what Vaga has already told. There is one scenario where exercising is actually beneficial. So there is one strategy called covered call.
Yeah.
You're aware of the strategy?
Yeah.
Yeah. So basically, covered call is a strategy where what happens is, let's say that I have own Axis Bank shares. Let's say. Okay. Let's say that my average price of Axis Bank share is 100 rupees per share, and I own 1,200 shares. That is equivalent to the one lot of F&O. So I have 1,200 Axis Bank shares, each at the price of 100. Okay. Now what I do is I sell a call for let's say 500 strike price. Okay. If
you're giving away your right to purchase that stock.
No, I am because I'm selling a contract, because I'm selling an option, I am obligated to deliver the shares if the contract is exercised. Okay. Now, like Vaga explained, if you do not, if the contract keeps getting traded or till the last day, and let's say that the contract that I'm holding, I'm not selling it off, I'm just holding it till expiry, till the last minute of expiry. Expiry finishes, I'm still holding the contract. When I'm holding the contract, whoever is on the buy side, I need to deliver 1,200 shares to the person who has purchased my contract. Okay. Now the advantage I have by holding it till the end is that I will sell my 1,200 shares that I already hold in my demat at 500 rupees, because let's assume that the current price is 500. Okay, so I am making a profit of 400 rupees and I'm losing the premium that will be on top of the 500 call strike. So for example, if 500 strike is what I've sold and the current price is 550, let's say 50 is my loss. Okay,
Correct.
but since I have an underlying, I'm already holding the underlying of 1,200 shares. I'm going to sell them in the market, make a profit of 400 rupees, lose 50 rupees out of it, and still retain my 350 rupees.
In case of covered call, it's okay, Pawan. But generally, if I only hold the options contract without actually holding the underlying, how does it work?
Yeah, that also is when if you're expecting the price. For example, let's say that current price of Axis Bank is, let's say, 600. Okay, and
I hold an option at 550.
Yeah, you expect that the price of Axis Bank, let's say, will go to
650, let's say.
Yeah, 650 is too less. Typically, what happens is if you're expecting a wild movement in the stock, either up or down, okay, then it makes sense to hold an option, because you're buying an option at a current price of today, and you'll exercise it at a future price. So if the price of the stock goes up wildly, for example, from 600, from 500 to 700,
then my call option will come handy.
Yes, you are making a straight outright profit of 200 rupees and you're still holding the stock. So you're basically purchasing the stock at today's price.
No, that's not my question, Pawan.
Sorry?
No, what I do not have the underlying. I do not hold Axis.
No, you don't have the underlying. That's what I'm saying. No. Even when you don't have an underlying, the objective of taking the delivery of a share or giving the delivery of a share is when you expect that the stock will move wildly on either side. Okay, so that you can buy the option. See, as a buyer of an option, you have the right to exercise, isn't it?
Yes.
So when you're buying an option today, you're buying the option at today's market price.
Yes.
Today's
premium, you mean?
Exercise it at future price. In the future, when the price can go up or down.
Correct.
So if the price goes up wildly, so let's say today Axis Bank share is 500. After 1 month, you expect it to be 700.
Yeah.
And if you take the delivery of shares at 700, your purchase price is only 500.
Correct.
So that's an advantage you have, right? So you are basically making an outright profit of 200 rupees and you're getting delivery of shares also.
So that delivery will have to be done by the person who is
selling.
Who will selling the call option.
Contract, yes.
Contract. Yeah, okay.
Yeah. Seller has to deliver, buyer has to accept.
Okay.
Yeah.
Thank you.
Okay, shall we go ahead?
Yeah, we can. We can.
Okay, cool. So, now, as Pawan said, you will buy a call option when you expect the price of an asset will go up much beyond the premium what you pay. Only then you will be beneficial. So the whole idea of buying a call option is you limit your losses and can make an unlimited gain. So suppose, let's go here. If I see the Reliance prices over like different period of times, if you would have bought, say, assuming, where is period? So if you were bought in September 2019 a call option, you were expecting that the price of Reliance would go more than 1,200, at which it was trading around 1,250, and you bought a call option here. And if the prices has moved, say, moved up to like 1,000, up to 1,600, what you would have paid here when you bought is the premium, which will be about around, say, 100 rupees if you bought depending on the strike price at which you bought. Say you expect that the price would go beyond 1300 and it went up to 1600. Your profit is 300 rupees in that, which is like 1600 minus 1300. Whatever profit you made, that whatever the price that changed, that is your profit. But if the price suppose goes down beyond 1300, what you will lose is only the premium what you have paid. So here in this case, you are buying a call option to limit your losses, but there's a possibility of unlimited gains, as the price can go like to any level. Practically it doesn't happen, but theoretically it can go to any level, and your losses get limited to whatever the premium you pay of an asset. If the price goes again, if it goes against you, what you have thought of it. And similarly, yeah, so in a buyer's payoff for a put option is you buy a put option when you're expecting that the price would go down in the near future. When you're expecting the price would go far down in the near future, and you want to buy a put option wherein you will limit your loss in terms of paying the premium, how much you pay for it, but your gain will be limited only up to would be limited till like strike price minus zero by zero, because whatever the underlying asset, it can go up to zero, it can't go beyond zero, it can't go negative. So that's why I've said like your gains are limited up to the strike price minus zero. These are like rare scenarios where it doesn't happen, but you don't have an unlimited gain in a put option. Got it, Saikir? And that's what I was, your question was there earlier on this. Sai? Okay, yeah, if that's right, then we'll understand the moneyness of the options. So we have three types of in the money, out of the money, and at the money. So, so when you're buying a call option, you are generally either buying it in the money, out at the money, or out of the money. So in the money, in case of a call option, is when your strike price is lower than your underlying price, you're in the money. Generally, you pay a higher premium for in the money contracts. And when your strike price and the spot price, when you're buying a contract, is generally around this, your strike price is around this spot price of the contract is at the money. And when your strike price is above the spot price, then it's out of the money contracts. This is the terminology being used, and this is in case of a call option. Reverse is in case of a put option. So in the money is, since you're in the put option, since you're expecting the market to go down and the price to go down, you're in the money when your strike price is higher than your underlying stock price, whenever you're buying it or whenever you're reviewing a position. And at the money is like when your strike price is around the underlying stock price, and out of the money is when your strike price is lower than your underlying stock price. Generally, you will pay a higher premium in the money contracts, and a lower premium in the out of the money contracts. So yeah, this is for today, and in the next session we will try to understand the different concepts in options premium, calculating options premium, and the few strategies around it.
Lovely.
Yeah, let me know if you got any questions.
Guys, I'll put up the recording in the drive folder.